Hi, class. This is our Week 2 lecture on Chapter 3, which primarily covers the fraudulent activities of Sunbeam Corporation in the late 1990s. I have a lot of good information in this video and hope that it will help you with your Chapter 3 assignments. We first start with the learning objective. We have 8 learning objectives. First, we learn how to recognize how a record of problematic executive leadership and a flashy leadership style may signal potential problems within a company. We learn to explain the meaning of the term improper revenue recognition, and we list the methods that Sunbeam used to recognize future period sales in current periods. We learn how to identify the conditions under which bill and hold sales can legitimately be recognized in accordance with generally accepted accounting principles. We learn how to identify the signals in financial statements that could alert you to the possibility that future periods' revenues has been recognized in current periods. And number 6, explain how restructuring reserves can be used to overstate earnings in future periods. To identify the signals in financial statements that could alert one to the possibility that a company may be misusing restructuring reserves in order to overstate earnings. And finally, number 8, explain why downsizing by closing segments that report an accounting loss often leads to a decrease in profits rather than an increase. Sunbeam started as a manufacturer of agricultural implements and was called Chicago Flexible Shaft Company. Later it began producing toasters and irons and changed its name to Sunbeam Corporation. In 1960, it acquired Oyster Company and added more high-tech electronic products to its range. Due to fierce competition in the industry, it felt that being acquired by Allegheny International Inc. was the best option. However, the extravagant lifestyle of Allegheny's CEO led to a distraction in business focus. This eventually resulted in evaporation of company profits. The new management team cut 1/3 of the company's jobs and sold off a number of their product lines as part of their aggressive downsizing program. As a result, the sales went down and the company filed for bankruptcy in 1988. Sunbeam emerged from bankruptcy under the control of Michael Price of the Mutual Series Investment Fund and Michael Steinhardt of the Steinhardt Partners Fund. They appointed Kazarine, one of the two deal makers, as the CEO. Kazarine's intense leadership led to a true turnaround of the company profits. However, he appeared to be a workaholic and was too intense for some. He was later replaced by Roger Shipke, who turned out to be too laid back in his approach. Without a powerful leader, profits fell quickly and steadily. Price and Steinhardt felt the need for a powerful CEO who had slashed costs in companies, cut production plants and products, and who had reported a profit so quickly after a period of losses that it was almost too good to be true. They hired Al Dunlap, who had done all of this before for Scott Paper and then sold it for a huge profit. The restructuring plan is a major plan to reorganize a company either in the form of downsizing, changing the company's capital structure, or reorganizing the company's debt agreements. Dunlap's restructuring plan for Sunbeam was to slash costs by closing production plants, dropping product lines, and slashing workers' jobs. Cost accounting analysis shows that when a company closes down a segment, it loses the segment's revenues, but does not lose all of the costs that are allocated to it in typical income statements. Common or allocated fixed costs that support more than one segment of a business and will not decrease if one segment is eliminated. These costs will remain and are carried by the remaining divisions. And traceable fixed costs are costs that exist because a particular business segment exists. Traceable fixed costs are eliminated if the segment is closed down. Therefore, a cost analysis must be done before eliminating a segment to ensure that the benefits exceeds cost. Cost cutting must be done scientifically to cut only costs that do not support greater revenues. As part of Sunbeam's cost-cutting plan, Dunlap announced that the company would immediately get rid of half of its 12,000 employees, shut down about 40 of its 61 warehouses, cut loose almost 90% of its product line, get rid of more than half of 26 factories, eliminate the majority of its offices. The major flaw in Dunlap's strategy was that maximization is not achieved by just cutting production facilities and employees or cutting R&D and marketing costs. Profits maximize when total revenues exceed total costs by the greatest amount. Cutting is likely to reduce revenues more than it reduces cost, and that will lead to less profit. With the huge downsizing, it was impossible for Sunbeam to meet its sales and profit targets. However, it eventually did. As it later turned out, it used two major schemes to make its financial statements appear to be much healthier than they actually were: improper timing of revenue recognition and improper use of restructuring reserves. Revenue must be recognized in the books of accounts only when it is earned. Improper timing of revenue recognition is the process of formally recording a revenue item in the financial statements in an earlier or later period than the period in which the item should have been recorded. In the years 1997 and 1998, Sunbeam used various schemes to inflate its sales and meet its unrealistic sales estimates. Sunbeam offered deep discounts and extended payment terms to get customers to place the next period's orders early. The acceleration of future quarters' sales into present quarter provided a misleading impression of the company's results of operation. The company failed to disclose this in its quarterly filings on Form 10-Q. Sunbeam also offered its customers the right to return the goods if they could not be sold. This increased the current period sales. However, these were contingent sales or guaranteed sales, and GAAP does not permit the recognition of revenue transactions lacking economic substance. Revenue recognition is the process of recording a transaction in the financial statements, indicating that the conditions have been met for the earning of revenue. Sunbeam also did not increase the reserve for the returns in their accounting records. This overstated the profits. The bill and hold sales. A sale is recorded when the order is placed, but the goods are held for delivery until a later date. There are several criteria to be met in order to record a bill and hold sales. Buyer, not the seller, must request for a bill and hold transaction. Buyer must have a substantial business purpose for the request, and risk of ownership must have passed to the buyer. On FOB shipping, ownership passes to the customer when goods are shipped. On FOB destination, ownership passes to the customer when goods are delivered. Sunbeam used bill and hold sales aggressively and recorded these as current period sales, even though they did not meet the above criteria. Sunbeam sold products that it planned to discontinue. These sales should have been reported separately from continuing sales as an infrequent event, but they were recorded as regular, ongoing sales. This gave a misleading picture of sales growth and future growth of the company. Sunbeam also created cookie jar reserves by overstating the amount by which the inventory had to be written down for all the segments that were going to be closed as part of restructuring in 1996. Cookie jar reserves that are created by overstating a future liability in one period in order to release it in a future period, thereby implying that a company has less expense in future periods. They later sold these inventories at a higher price than was recorded. This resulted in overstatement of profits. Sunbeam entered into an inconclusive sales agreement with a fulfillment house to sell an intermediate amount of spare parts. They also guaranteed a profit of 5% on future resale. Despite the conditional and intermediate nature of this agreement, Sunbeam recorded $11 million in sales and $5 million profit on the sale in 1997. Sunbeam recorded rebates on future purchases as deductions from the current period's cost of goods expense. According to GAAP, rebates should decrease the cost of goods sold expense in the period that the goods are sold. Sunbeam applied these rebates to decrease cost of goods sold in the period that it signed the rebate contracts. This led to an understatement of expenses. In the first quarter of 1998, in order to include the results of its newly acquired companies, Sunbeam extended its quarter end from March 29th to March 31st. This was not mentioned in its press release on April 3rd of the same year. Sunbeam was also accused of misleading press releases. It also denied its channel stuffing allegations. Channel stuffing, persuading customers to place a later period's orders in the current period. Essentially, the seller stuffs more inventory into the customer's warehouses than the customer currently needs. When a reserve is created, the expense is recognized in the current period. When the loss occurs in the future, the amount is offset against the reserve. Sunbeam created overstated reserves upon the implementation of its downsizing and restricting ploy and the acquisition of Coleman, First Alert, and Signature Brands. It later released these reserves into earnings. Since these reserves are special charges, their recognition didn't affect the stock prices negatively. The quality of a company's leadership is the primary signal with regard to whether its financial statements are likely to be fraudulently reported. The track record of the companies that Dunlap had managed before joining Sunbeam, most notably Scott Paper, was a signal of the possibility of fraudulent reporting. This general signal of the quality and track record of company leaders should be combined with an analysis of whether the business plan outlined by management is likely to produce the reported results as published in the financial statements. The implausibility of the reported financial results in relation to Sunbeam's major downsizing plan was a major signal of fictitious financial reporting. Increase in accounts receivable as a percent of sales is a signal that the sales are being overstated. This is because while legitimate sales will be paid relatively soon by the customers and will turn into cash, the next period's sales, or fictitious sales, will probably only be paid next period and will remain on the balance sheet in the current period as accounts receivable instead of turning into cash. The receivables to sales ratio can be calculated by dividing accounts receivable at the end of any quarter by the addition of the sales for the 4 quarters ending on that date. For example, in the first quarter of 1997, receivables to sales ratio is 29.44%, calculated as $296,716, that is the Q1 1997 receivables, divided by $253,896 plus $231,770 plus $268,863 plus $253,450, and that's sales from Q2 1996 to Q1 1997. Sudden changes in gross margins of Sunbeam were probably due in part to practices like selling inventory in 1997 at better prices than the restructuring purported to anticipate, because some inventory had been valued at incorrectly low amounts. The statement of cash flows is separated into 3 segments: the cash flow from operations, the cash flow from investing activities, and the cash flow from financing the business. So the section called cash flow from operations should not show an amount of cash generated that is significantly less than the profit from operations, listed as operating income or operating earnings in the income statement, without a very specific explanation. The huge gap between Sunbeam's reported operating income and cash flow from operations was a strong signal of fraudulent reporting. In the case of Sunbeam, the aggressive revenue recognition was easy to spot. One of the notes to the financial statements in the company's 1997 annual report mentioned the bill and hold sales policy. Encouraging customers to place their orders early is also a signal of a possible overstatement of sales. In order to get information on this kind of channel stuffing, analysts and investors should scan the 10Q and 10K reports and also conduct article searches via search engines such as Google and databases such as LexisNexis or ProQuest. In Sunbeam's case, the SEC found that, in total, $24.7 million in fourth quarter 1997 sales to distributors were subject to rights of return. A reserve for such returns should be accounted for in the financial statements according to the Financial Accounting Standards Board, SFAS 48. However, the SEC reported that because such sales were a significant change in approach for Sunbeam and the likely return amounts were not known, it should not have reported these sales. This was the case with Sunbeam's March and April press releases discussed earlier. Again, analysts and investors should perform internet or database searches for press releases or for articles referring to press releases that revise earlier public statements in quick succession. Large one-time charges in the income statement should alert the reader to the possibility that future periods' earnings may be inflated as the reserves are released back into profits, or as the written down assets are sold at normal prices. Sunbeam's income statement showed a massive restructuring charge of $154.9 million in the last quarter of 1996 that included the overall accruals for items such as the advertising reserve and the litigation reserve. Such creation of reserves signals that future expenses are possibly being recognized early with the creation of improper reserves. If restructuring reserves or reserves resulting from other one-time charges appear in the financial statements upon the arrival of a new CEO, it is an even stronger alert that future expenses are possibly being recognized early with the creation of improper reserves. Al Dunlap was appointed CEO of Sunbeam on July 18, 1996, and the massive restructuring reserves were created in the last quarter of 1996. When reserves decrease rapidly, it is an indication that earnings in the period may have been inflated by avoiding expenses through the reversal of the reserves. Sunbeam's restructuring accrual decreased from $63.8 million in the last quarter of 1996 to $45.3 million in the last quarter of 1997, and then it was released steadily until it reached zero at the end of the first quarter of 1998. Cookie jar reserves do not result in inflow of cash. However, these increase operating income. When Sunbeam simultaneously reported large operating profits in 1997, but negative cash flow from operations, it was time to bail out of the company and its stock as quickly as possible.